So my name's Eric Turner. I'm the CEO at Masari. We're a market data company focused on providing crypto data for institutions. We have a great group here today. We're going to be talking about taking the temperature of the institutional crypto space and some of the trends we're seeing today. So how about everybody kick off? We'll go around, do a round of introductions, and then we'll get started.
Sure. So my name's Chris Tyra. I'm head of institutional at Bullish. Bullish is a regulated crypto exchange that's institutionally focused. We launched a little over 3 years ago. We've grown very quickly in that time, and we're now sort of top 5 venue for spot Bitcoin and ETH liquidity.
Thanks, Eric. My name is David Rogers. I'm the APAC CEO of B2C2. We've been in existence for about 10 years now. We're one of the original and largest providers of liquidity, credit, and market-making services in the digital asset space, probably trading between 5 and 10% of Bitcoin's legitimate, measurable daily volume, and do a number of things from running a large OTC business to funding, derivatives, inventory management, and tokenization projects.
Hey everybody, my name is Mike Belshe. I am founder, CEO of BitGo. I think we're the largest independent custodian in digital assets. We are mostly known in the US, but we've got custodians in Switzerland, Germany, Dubai, Singapore, a number of them, and continue to push forward on digital asset space since 2013.
Hey everyone, I'm Ryan Rasmussen. I'm the head of research at Bitwise Asset Management. We're a crypto asset manager based in the States and launched Bitcoin ETF and Ethereum ETFs and have been around since 2017, helping Wall Street institutional investors, financial advisors, and the such access crypto.
All right, great. Well, I think the best way to kick off here is probably one of the bigger stories this year when it comes to the institutional space and what we've seen. Ryan, you just mentioned it. You know, we had the launch of the Bitcoin and the ETH ETFs in the US, and we've seen some others pop up in other places. So I'm curious, when we look at the ETFs, have we seen, we've obviously seen those be successful, but have we seen new participants enter the space? What is the mix of the institutional side? What does it look like today? Has it changed at all with those launches?
Yeah, it's really interesting. So the Bitcoin ETFs that launched in January have been the most successful ETF launches of all time collectively across the 11 different ETFs. They've gathered somewhere around 20 billion in assets over the past 9 months. Ethereum ETFs came next, haven't been quite as successful, but still we've seen a lot of investors adopt both ETFs. As far as new entrants into the market, we've certainly seen financial advisors and RIAs and even some of the wirehouses like Morgan Stanley start to adopt the ETFs. It's one of the main ways that they access any kind of traditional investment is through this ETF format. It's cheap, it's easy to use, it fits into their workflow, it's regulated, uses institutional grade custodians, and so for that reason we have seen a lot of adoption. I think it comes in waves. So if you think about the different types of investors, you have self-directed investors, probably most of us in the room, or also referred to as retail investors for the most part. Those are the early adopters of the ETFs. And you would think that most retail investors might use Coinbase, might use another exchange, might use Bullish, might self-custody crypto. But then there's also those same investors who want access to the ETFs, to crypto, through their 401ks or their IRAs or just in their brokerage account where they have a good amount of capital. And so that's been the first wave. It's been self-directed and client investments in the ETFs. There's also the RIAs, or registered investment advisors, and family offices who can move a little bit quicker than other big institutions. They've been the second wave of adopters. And then, like I mentioned, Morgan Stanley, these big wirehouses, they move a lot slower because they have large compliance divisions, due diligence divisions, and departments that have to review and sign off on everything. And so the adoption's been really great, but it's been slow for some institutions and quick for others. Yeah.
I'm curious when we think about, obviously the ETFs, those have been Bitcoin and Ethereum. right? We haven't seen any other ETFs really approved or ones that are going to be approved at size right now. You know, for Chris, sitting on the exchange side of things, what have you seen people interested in? Has it been primarily Bitcoin and Ethereum, or have investors been looking a little bit outside of just those top two?
Yeah, look, I think that Bitcoin and ETH are still the vast majority of institutional volumes. What I would say is that, to your earlier point about how, the ETH ETF attracted a lot less in terms of assets, I think that just comes down to the fact that, like, Bitcoin has really carved out its use case. If we rewind to sort of 2017 and looked at the top 10 assets, yeah, sure, we had Bitcoin, ETH, and XRP, but then we just had a lot of things that looked like Bitcoin. It was Bitcoin Cash, it was Litecoin, it was Monero, it was Zcash, Bitcoin SV, et cetera, et cetera. And that's all kind of died away, and like Bitcoin has really won that. So I kind of think of the marketplace now as being Bitcoin and then crypto. And so if we look at sort of ETH as an asset, it has a lot more competition. And, just in terms of like, is it going to be a winner takes all in terms of L1s, monolithic versus modular? As we think about the blockchain trilemma, are the local maxima that would suggest that we'll have multiple chains for different use cases? And so I think that, institutions are, interested in Bitcoin as a macro asset, but then interested in getting broad market crypto exposure. And at the minute, one of the only ways to really do that effectively is via venture capital. And I think in the fullness of time, that will change. If you think of the crypto market, it doesn't have a widely accepted broad market indexes yet. Now, every other market has a widely accepted broad market index, and so if for the dollar, that's the Dixie. For commodities, that's the Goldman Sachs Commodities Index. For UK equities, it's the FTSE 100, and it doesn't want to exist in crypto. And so I think that CoinDesk is doing a very good job of promoting the CoinDesk 20. We listed a perp on that at the beginning of the year. It's traded $8 billion so far. And so I think we'll start to see institutions push more into like broad spectrum exposure, which kind of suits the sort of RAA type allocations as well.
That's actually, that's something interesting. So I think I saw that Bullish is offering a product, like you said, that's based off of the CoinDesk indices.
Yep.
So there's the ability to actually, I think it's perps or something like that, to invest that way. So I'll leave this open to anyone on the panel, but have you seen any shifts in the way that the institutions and institutional investors are approaching the space? Any sort of instruments or anything they're using outside of just what we've talked about, pure spot investments?
Yeah, I mean, I can speak to I would say the non-mainstream institutional space, such as the family office and corporate space here in Asia. They are consumers of balance sheet. A lot of what we do at BTC2 is around derivative structuring trade, or funding is a large part. I mean, what happens is that when you have an OTC business and you take in assets on a title transfer business, you can sort of lend those assets out. I think generally people, when they're looking for anything that involves protecting, enhancing, or diversifying income streams, they will want to put on some sort of derivative structuring trade. So it could be a simple shark fin option structure, or it could be a miner looking for a liquidation risk-free loan that protects their USD OPEX, for example. So anything where there's kind of protection or enhancement around the core product, we see quite a lot of. And as I say, the funding business particularly is special, because a lot of people, for example, will run a fund that takes remittances in US dollars, but then have a staking business in ETH, and they may want to transfer the two in the form of a swap. So that's often a common structure we would see.
So building on that, I actually want to go back, Ryan, and I had a question there. So you talked about RIAs, you talked about the ETFs being a vehicle for retail to get more exposure. Have you seen these larger asset managers, so like the Fidelities of the world, and people that are actually managing mutual funds, retail-focused funds, or ETFs, have you seen them start to be interested in spot exposure to crypto?
Yeah, I think across the institutional board, you're seeing a lot of interest, particularly now we have the kind of economic dynamics. We have lower interest rates as of today or yesterday, and you have this more accessible product like these ETFs. So all of a sudden, adding crypto to your portfolio for a range of institutional investors is this new thing that they're excited about. We've seen the tide shift in the past 12 to 18 months where you go from FTX and Sam Bankman-Fried to Larry Fink, the CEO of the largest financial institution in the world, pitching Bitcoin on CNBC and talking to Jim Cramer about tokenizing every asset in the world. And so when you have that transition, you naturally have financial advisors and RAs and investors who don't spend a lot of time thinking about crypto, but manage money. They manage money for parents and teachers and grandparents, and they are certainly interested in getting exposure to crypto. And so with that, a lot of those wealth managers use model portfolios, right? BlackRock, Fidelity, other institutions run model portfolios. Even the large and small RIAs do the same thing, and within those model portfolios, what we're seeing now, and what I find really interesting going around and meeting with these different RAs, is that it used to be a struggle to get them to add 1% allocation to Bitcoin to that model portfolio. Now those conversations are, maybe we're going to add 5% crypto to the model portfolio. So traditional 60-40, 80-20 portfolio, but 5% exposure to crypto. And it's not just Bitcoin, it's maybe 60-40 Bitcoin and Ethereum. So it's getting a little bit more, what they would consider exotic. And it's certainly partly due to the institutional interest from the Larry Finks of the world and the CIOs of these large investment management firms talking about it in the mainstream media.
Yeah, and to add to that, I would say that since the launch of the ETFs at the start of the year, the amount of institutional clients from that traditional segment has really increased. Like we've really seen that proportion of onboarding requests move to those traditional asset managers and hedge funds, that kind of thing. But the point on this that I think is important here is that the conversation around parental guarantees is quite large because you've got a bunch of new clients wanting to move into the space, and they're dealing with counterparties that they're not used to, and they haven't necessarily established a cadence with. And obviously, crypto is a pre-funded asset class. They need guarantees around the underwriting of those assets that they place with a liquidity provider, exchange, and whatnot. And I think the issue of parental guarantees and underwriting that will become quite important as more of these larger asset managers come online. And then that moves the conversation into sort of balance sheets, right? And whether or not you can support a much larger institutional client base, because it is, again, it's very balance sheet consumptive if you do that.
What else do we need to do to make institutions comfortable with crypto? So, I think regulation was kind of this forcing function. I think getting the ETFs approved, we've talked about that a lot. We've just talked about, some of the things that we're looking at structurally. But is there anything, we obviously have a group here, and you all kind of represent different parts of the stack within the space. Is there anything that we could be doing, you could be doing, to make it easier for institutions to make that decision to onboard into crypto, to allocate into crypto? Is that something where it is about the asset class itself, or is there something from the infrastructure perspective that they're used to, coming from TradFi, coming from their world, that we should be building towards?
I think the regulation is the obvious answer to this question, right? So there's definitely probably pretty much every institution is concerned about, are they going to end up with having some sort of blowback on the other side? So the ETF is, of course, a wonderful thing here. It fits within kind of the known constructs that they can participate in, and it kind of takes that away. But it's not a very interesting step into the market, right? I mean, okay, so you can have an ETF, a lot of ETFs out there, but it doesn't allow you to start using the money in interesting ways. We still don't have in-kind deposits and withdrawals, right? That's another interesting part of the market that's missing. But the number one thing that could happen is, for sure, like, get the regulatory clarity around what's allowed, what's not, so that people don't feel like they're going to get fired if they go down this path.
I think, to add to that, there's, the ETF definitely solves a market access problem for people who don't want to have to onboard the expertise in order to evaluate a custodian by themselves, or they have, for retail, they have a Charles Schwab account and they just want to be able to buy something through one account and don't have to have, a separate account on the side. So I think that it definitely solves a market access problem for certain constituents. But the vast majority of institutional capital comes through banks. And right now, the banks can't do anything owing to the capital requirements that are placed on them through SAB 121 and through Basel III. And so without addressing that and bringing, banks in, there's going to be throttled exposure.
Actually, you raise a good point. So it's not just SAB 121, it's also OCC being really negative. But even beyond that, traditional finance, Wall Street, it's all public companies with very few exceptions. I give Fidelity, I guess. But in general, in terms of being counterparties to each other, it's public companies, public financial disclosures, et cetera. Now, those things fail, as evidenced by 2008. But it gives them a buffer. It gives them something to point at. Hey, there's a whole regulator. There's all these disclosures. They can count on that. And when the traditional finance companies, came to crypto and said, hey, there's this Sequoia-backed company. It's pretty good. It's called FTX, and let's go do that. And of course, they got stung. So they've learned that the diligence from Silicon Valley is pure crap, and they can't touch private companies. And so they're definitely gun shy around that. So we've seen this with the ETF, right? What happened? All the initial custody, with the exception of two that came to BitGo, started out with their custody at a public company. And this was designed from a couple of perspectives. A, greasing the skids for the smoothest path through the SEC. But B, it's also true. Like, there's one company in the crypto space that's public. Only one, right? One major one. So anyway, getting more public companies, I hate to say it, probably is a pretty good unlock for the traditional financial firms.
And to add to that, I would also say that the crypto industry probably isn't doing itself many favors by trying to play that kind of geographical or regulatory arb. Like, people are constantly trying to set up companies in jurisdictions that they don't necessarily have an institutional presence in, and trying to sort of port that in as a marketing technique into that jurisdiction. And I think that's the problem, right? And with, we're here in Singapore today. We're going down the road of getting our mass license, and that is a long and arduous and expensive process, right? So it's understandable why firms don't want to do that. But I mean, to Mark's point, I think that regulatory acceptance is really the only game in town. And if you are to move into those sort of centralized, traditional asset managers, you're going to need that badge from the major licenses. A lot of firms choose not to go down that path. That's their prerogative. But I think that if the direction of travel is to move to those hedge funds and asset managers that we're talking about coming into the space, I think they're only going to deal with regulated, well-capitalized, stable companies.
Mike, you were mentioning that, a public company for large institutions is the path of least resistance. It's something they feel comfortable with. What's going to change that for this space? I mean, you said there's one that everybody knows about, but in the US, but do you think that we're going to see crypto companies that are crypto native go public, or do you think it's something where we need the JP Morgans and the Goldman Sachses of the world to start offering custody and some of these other solutions?
I think we're going to see public companies sooner or later. So look, maybe it'll be November 5th we start to see like the pipeline of public companies go, or maybe it's going to be another 4 years. Eventually that happens. In the meantime, you've got the question of, will the traditional financial firms be able to come around and materially participate? And look, here I think we end up with a 0 to 1 type of dichotomy, or maybe an innovator's dilemma type of dichotomy, where the large firms are looking at a business where they understand the risk and a much larger profitability of that risk, and so they can operate that. When it comes to crypto, you still have an inversion where the profitability of it is almost nothing and the risk is super high. So what's the time period where they will start inverting? like, I don't know, I think the market just has to get a heck of a lot bigger in order for them to be able to try to jump over that risk that they've currently got inherent with crypto.
Yeah, I would just add to that I think we'll certainly see a lot more publicly traded crypto companies. I mean, we know Circle is set to, or plans to go public sometime in the next 12 months or so, but for traditional investors, RIAs, the financial advisors that we're talking about, institutions, they can easily allocate to any equity. They don't have to go through some long risk review, due diligence process and make sure that they're allowed to do it to them on their reports that they're printing out and that the compliance team are reviewing. It just looks like another equity. It looks like a NVIDIA or a Tesla or an Apple. And so for publicly traded crypto companies to become more, or for there to be more publicly traded companies, I think that institutional investors will eat that up, especially with the volatility that crypto brings. I think that's why you see interesting products like covered call strategies on MicroStrategy. There's some ETFs that have been really successful in that space. Same with Coinbase covered call strategies. And so investors will eat it up as long as the opportunities are there and the products are there. And I think we'll see a lot more of those coming down the pike. I agree with that.
I should, just to be pedantic, I should probably add that there is a second publicly listed crypto company, us, because our parent is SBI and we're listed in Japan. But
I'm sorry.
Just to correct the point there. But it also speaks to the sort of the parental guarantee and the counterparty risk side. But I agree with you. I think there needs to be more publicly listed company in addition with the regulated side for sure.
But you know, Mike touched on it, but there would be a lot more if you had a favorable SEC. You know, yeah. It's not for. I think last cycle in 2021 we would have seen a lot more applications, and I think that you know it was just not a conducive environment to go in public in U.S. markets.
Well, I just got called out for being a little too U.S.-centric in this conversation, so I am curious, you know, I know we're here in Singapore, you mentioned MAS, and there are a lot of jurisdictions that have pretty clear frameworks for crypto. They're starting to at least build some of them out. We saw MiCA go live, or you know, part of it go live in the EU. So I'm wondering, outside of the US, outside of us sitting here just waiting for the election to happen and seeing what happens, are there any other bright spots where you're seeing regulation actually become a catalyst for adoption and getting institutions comfortable?
Yeah, let me jump in on that. Talked to with regulators all over. Of course, in Europe, you know, MiCA starts to provide a pretty decent framework, along with an attitude that is favorable towards iterating on that to make it stronger. You know, of course, Dubai and Singapore have both been doing a lot of really good work in terms of starting to provide frameworks that work. Japan actually deserves more credit than they get. Maybe because they were stung by Mt. Gox and CoinCheck in the early days. They actually have a crypto exchange license, which is pretty far along. So I think there's a number of good jurisdictions. There still is a hesitancy when the US is negative. So you talk to certain groups, certain regulators, and they will tell you this, you know, quite clearly. If the US will lead and kind of open up, then that makes it a lot easier for them. It gives them a little bit of air cover as well. But anyway, yeah, Dubai and Singapore, I think both bright spots. Europe is looking interesting. This is all going to get sorted over some time horizon. Hopefully we're moving in the right direction.
Yeah, I mean, the thing to add, of course, is that the US is, what, 5% of population, 24% of global GDP, but it's 40% of investment capital and over 80% of derivatives. And so whichever way you cut it, they're just enormously significant when it comes to, you know, developing any kind of marketplace.
Yeah, and I think just to comment on sort of ASEAN belt as we're here in Singapore, Mike's right in the progressiveness of the Singapore authorities here, and it has been good in spite of the issues we've had in Singapore, and obviously public confidence was really affected with a number of issues we've had here in Singapore. But generally, I would comment that through the ASEAN belt, there's a number of different regulatory regimes. Most people are sort of crypto-friendly. I mean, for example, if you go to Thailand, a highly restricted sort of currency-control-based country, but the Bank of Thailand has also already got a live sandbox environment for a tokenized version of the baht. And that's going to be important because it means that institutional businesses and ones that face them like ours can go there and freely move currency, and that, I think, will help as well. So I think the regulators are listening, but I think the big point here with regulatory regimes in this part of the world is just that consumer protection sits up here and everything else is below it. So long as the consumers are protected going forward, I think there will be acceptance. And Chris made the point about sort of the banking sector as well. That is driven entirely by government policy and political agenda. And once we get that bit aligned, once the consumer protection is there, you will see that, that regulatory freeing up, I think.
So we mentioned MiCA, and I think a couple of the other regulations, and an interesting piece of the way that those regulations have been created is stablecoins are very narrowly defined. They're separated from regulation of other types of crypto assets. So want to pose this to anyone on the panel, but I'm curious. I hear a lot about stablecoins are being used to power payment apps, and things that are very retail and individual facing. But what role have stablecoins played on the institutional side recently?
Well, I think certainly from an exchange perspective, it's it's fast payment rails, it's being able to recycle capital, being able to reuse that capital a lot more efficiently. I mean, it's funny because you look at kind of like MiCA as a regulatory framework, and there was a lot of it that was focused on stablecoins, which is almost like a snapshot in time because it was around the time that Libra was launching, and that obviously was the stable that never really came to be, but. Yeah, so it's like an over-focus on stablecoins given the sort of scope of the market. But yeah, I mean, I think they're incredibly important, and just in terms of recycling risk capital, certainly from an institutional perspective.
Yeah. Look, I think the banks have been fairly weak on just payments products for decades now, right? So, I mean, PayPal, Venmo, WeChat Pay, Alipay, like down the line. Like the tech companies are just kicking butt against the banks when it comes to payments, and that's without even having stable coins, which start to move around much more freely and openly. So, it's the whole payment space. I think is ripe for disruption. Stablecoins can play a huge role in terms of opening up, especially international remittances and payments. Yeah.
Yeah. I mean, I couldn't agree more. I mean, like the institutional space, sort of lives and dies on the hill of value transfer. Like because you're constantly moving into an asset, and again in Asia, it's very much an on-ramp focused market here, and having that ability to move from fiat into crypto, and having instant delivery is everything. Because when I think about infrastructure, I think about just, you could think about pricing and trading platforms and algos, but actually the real problem to solve is that transfer of values. And I couldn't agree more, Mike. Like, it is ripe for disruption in the payment space. It's antiquated. If you can become sort of like that wholesaler of cash and it moves, I think that's very powerful. And stablecoins will be the driver of that.
Even just the basics of 24/7 markets, right?
Yeah.
So stablecoins are going to completely reduce risk in that from Friday to Monday, you can now settle this stuff instantly. And this has been a thorn in building faster, better markets. You build faster, better markets, you get more business. Long known.
Yeah, and it's also a stable asset. Remember, it's underpinned by a currency. You get a bit of a premium when markets are moving higher, and you get a bit of a discount when they're coming off. But essentially, that's stable. You know where that is. You can keep a reserve, and it can fund all things. From, we see use cases not just from, say, native crypto retail platforms trading that need that, but also, again, in this part of the world, you're going to have an awful lot of sort of merchant, non-native crypto users who want to be remitted in their local currency, but actually receive stables as the merchant. And they may be building a balance from there. They may be affecting cross-border payments with that. They may be speculating on the market, and can you go into other assets? And it will be, I think, the de facto vehicle by which we move value.
I mean, stablecoins also lower the cost for merchants. That's a great example of institutions that can benefit from stablecoins, regardless of the settlement rails. The fact that they're paying lower fees, especially when you have blockchains at scale, whether it's Solana or Ethereum Layer 2s or some other blockchain that is very low fee, you're not paying 1, 2, 3% on every transaction like you do with credit card fees or with the banking fees in some areas of the world. So stablecoins are a huge unlock and a huge cost saver from that perspective on its own. And then there's all these other capital efficiency and float improvements that happen for these mom and pop businesses, or even somewhat larger businesses that struggle with banking rails in outside of the U.S. and in other emerging countries where they just don't have access to traditional banking rails. And stablecoins is such a huge unlock for that corner of the market. I think it's going to be one of the biggest and most important financial innovations when we look back over the past few decades. I think stablecoins are up there with some of the most important financial innovations that we've seen.
I feel like we have a lot of stablecoins now. We have $1 US and a bunch of stablecoins that are backed by the US dollar. So I'm curious, do we see a winner that takes all in the stablecoin industry? I mean, what makes a stablecoin good, a stablecoin bad? Like, what is that edge going to be if we do see a winner emerge?
It's kind of like asking, like, shouldn't there just be one big bank? I don't know, maybe we call it JP Morgan or something. And
I don't think it should be a bank, first of all.
of course, you should always have a plethora of solutions that have got competition between them. You're going to have it, of course, on the product, on the input and output rails. You're going to have how programmable is it for interfacing with other types of applications. You're going to have geographical and regulatory restrictions all over the world. There's going to be a ton. So, look, I don't know. We probably have too many right now. Maybe that's your point. But of course, there's going to be many, and there should be. It's also de-risking to not have it all your eggs in one basket. So I think we're going to continue to see a healthy ecosystem of stablecoins.
Yeah, I probably have a slightly different view. Like, I think that stablecoins are networks, and so like the JP Morgan, like I get you don't have one bank, but it's, several banks are using the same rails, and so actually they interoperate quite well. Unless you have that interoperability between stables, they are just separate and distinct networks, and you limit the uses or limit the use cases. So I think completely agree that it's probably not like a one winner takes all. There maybe will be two, but I don't think there's going to be 20. I mean, you look at the way the kind of Europe is thinking about it, just in terms of the CBDC, it looks like they're more interested in a wholesale model. And you don't, I can almost see a kind of public-private partnership occurring between stable issuers, local stable issuers, and how they interoperate with the existing banking system. You definitely don't just want one. Like, that's a far too riskier prospect. But I don't think it's going to be, I think owing to the fact that they are networks, there's going to be a very small number that are successful in each currency.
But I'd also go back to the point on regulations, right, around sort of, we've had concerns over depegging risk and so on and so forth. As you move into that regulatory arena, I think we're probably going to have the point where you have approved and non-approved coins, and that could be on the agenda. And again, you get that gravitational effect towards certain products and others. But it's important for competition in a nascent market. But I think, again, you're moving into that regulatory direction of travel for ones that will be, and I think that'll be a global standard. I wouldn't be surprised if we see from the major regulators globally, obviously we're talking about a stablecoin bill in the US, but I think that kind of thing will be replicated globally.
So I know we have just a few minutes here, so I want to wrap things up, and I want to go around and get everybody's hot take for next year, or what they think is going to be most important in the institutional space. So, Chris, I'll start with you. Would love to hear what you think 2025 is going to look like.
Is this the point where I tear my shirt off and shout 200K and run off stage? Or?
Absolutely.
What's the hot take for 2025? I think that it seems to me that we've had a very sort of muted market. It's really been, it feels like retail has been very absent. And I think that that's actually a good thing, to be honest. We've removed a lot of the sort of froth and a lot of the excess. So I think it's going to be relatively boring. Like, I think it's going to be a continuation of a grind higher. I think that we're kind of emerging out of this sort of 4-year cycle, and I think we're entering into a more mature market phase.
Yeah, I mean, I think optimistically, I'd love to see a crypto market that is less dependent on major catalysts. You know, it feels like the last major catalyst we had was at the beginning of the year with the ETF launch. The next one will be the election and so on. So I'd love to be able to sort of structurally move away from that. But I do think, though, that given that what we're talking about here, the institutional adoption is going to be key. Outside the ETFs, more funding, more derivative products, stuff outside spot. I think if we can start to see that, because credit markets are largely okay and in good shape, I would say, in crypto. If that gets going with the retail part underneath, I think we could be in good shape. And then structurally, we sort of feel that we're at a better level in the markets. But there's a lot of ifs there, I think.
It all comes down to one thing, and this is a little US-centric, but November 5th. That's going to define what happens in 2025. It's going to unlock or not. Yeah.
I think that we're going to see a lot more corporations and pension funds start allocating to Bitcoin. I think publicly traded companies are going to be seeing the fact that you're not getting as much yield in treasuries with interest rates coming down, and you're also getting this great premium. Just look at MicroStrategy, for example, when you announce that you're adding Bitcoin to your corporate treasury. And so I think we're going to see a lot more corporations, not a crazy number, but 5, 10 publicly traded companies that add Bitcoin to their balance sheet. I think that'll be a good catalyst. I think we'll see pension funds and endowments slowly do it. I spent a lot of time talking to the CIOs of these firms, and none of them want to be the first mover because there's career risk and because they're happy getting 5, 6, 7% yield in credit markets right now and in treasuries. But when those rates come down and you have to chase out the risk curve a little bit to get a better yield, Bitcoin starts to look like more of an attractive investment, a little bit less of a career risk because you need to go find those returns. And it's a great vehicle for that. It's uncorrelated with traditional assets. It's great when you add it to a portfolio from a diversification and from a returns perspective. And so I think we'll see corporations, endowments, pension funds adding Bitcoin.
Yeah, absolutely. So it sounds like 2025 is going to be good. A lot of optimism up here. Thank you, everybody, for joining us for the session. How about we give a big round of applause for all of our panelists for joining us?